Okay, let's talk about the last 24 hours in the crypto market because it has been nothing short of pure whiplash. We saw massive, terrifying sell-off and then a rebound that nobody saw coming. It's left pretty much everyone scratching their heads and asking one simple question: what is actually going on?
So right now, if you take the market's temperature, it's at rock bottom. The fear and greed index is flashing a 12, and that means extreme fear. Seriously, this is the kind of deep-seated panic we haven't seen in months, where it feels like the entire floor is about to give way.
But here's the billion-dollar question. If the entire market is supposedly paralyzed by this much fear, why on earth did prices suddenly slam on the brakes and start to recover? It just doesn't add up, right? Well, that's the central puzzle we're going to unpack today.
All right, so let's push past the feeling of fear for a second and dive into the cold, hard data. Because honestly, the numbers are telling a much more complex and, frankly, a much more interesting story.
First off, let's look at Bitcoin. It took a terrifying plunge, breaking below that huge psychological floor of $90,000 for the first time in 6 months. But then it fought back. It clawed its way back above 93,000. That tells you there's a real battle going on here, and the bears are not having as easy a time as they thought. Now, that drop was absolutely devastating for a lot of people. In a single day, over $1 billion in leveraged positions got completely wiped out. This was a brutal, brutal flush out, and it mostly hit traders who were betting on prices to go up. Just gone. And you can see that fear in the money flow. We saw nearly $2 billion get pulled from crypto investment products in just 1 week. That is a massive retreat. In fact, it's the biggest exodus of cash we've seen since all the way back in February.
But here's where it gets really interesting. Check out this split. While billions were fleeing the big dogs, Bitcoin and Ethereum, some investors were doing the exact opposite. Money was actually flowing into products for coins like XRP and Solana. So this panic, it wasn't universal. Some people saw this as a fire sale. And that right there is the crucial point. This chaos is creating this massive divide in the market. You've got two completely different kinds of investors making two completely different moves right now.
So on one side, you have what looks like the great retail escape. Those record outflows we just talked about, that smells like widespread panic selling from individual investors. But on the other side, you have the whales, the big institutional players. And they're not selling, they're quietly buying. They're accumulating, seeing all this fear as a prime opportunity.
And it's not just some anonymous whales. You have some of the smartest analysts in the game, guys like Tom Lee and Matt Hugin, and they're not calling this a crash. They're calling it market maker distress, which is basically a temporary plumbing issue. And, get this, a generational buying opportunity. They think this could be one of the best times to get in that we've seen in years. And one of the technical signals they're pointing to is this wonky-sounding thing called backwardation. Now, in simple terms, all this means is that the price for crypto in the future is actually lower than the price today. It's a really rare condition, and it often signals that the extreme selling pressure is finally getting exhausted. It could mean a bottom is very, very close.
You know, there's a whole other story happening completely separate from all this price drama. Because while traders are panicking, builders are still building. And actually, a recent crisis has only sped up the push to make this whole crypto ecosystem way more resilient.
So not long ago, Cloudflare, which is a huge piece of the internet's backbone, had a brief outage, and it knocked a bunch of major crypto exchanges and websites offline. It was this jarring reminder of how much of this supposedly decentralized world still hangs on a few very centralized points of failure.
And that event immediately sent a shockwave through the industry, sparking this really urgent question. How do we build a system that's truly unstoppable? One that can't be taken down just because one company has a bad day?
And one of the big answers that's getting a ton of momentum is something called DePIN. It stands for Decentralized Physical Infrastructure Networks. The core idea is to use the blockchain to manage the actual physical hardware of the internet, the servers, the networks, in a totally distributed way, so no single company holds the keys to the kingdom.
But what's really wild is that while retail was panicking and the techies were problem-solving, the big money just kept quietly flowing in. I mean, look at this. Major trading firms investing in exchanges, Harvard's endowment upping its Bitcoin stake by over 250%, brand new products launching on the NASDAQ, and even US regulators giving banks a green light to get more involved. The message here is crystal clear. The institutional bedrock of this industry is getting stronger, not weaker. So, where does that leave us? It's a confusing picture, right? You've got sheer panic in the streets, but you have calm confidence in the boardrooms. We have absolute chaos in the short term, but steady, quiet construction for the long term.
If there's one thing you should take away from all this, it's that the crypto market is locked in a fundamental tug-of-war. It is a battle between the gut-wrenching, short-term fear that's making individuals sell and the calculated, long-term faith that's driving institutions to buy and to build.
And that brings us to the final, critical question. As the market stands at this crossroads, completely torn between the fear of today and the faith in tomorrow, which one of these powerful forces is ultimately going to win out and write the next chapter for crypto?